Hello, everybody. I'm back, Mr. T. I haven't done one of these podcasts in a couple of months, and as you know, it's been cold, so I didn't come out. What can I say? But it's good to be back. I have one of my latest guests, and I'm going to call him the money man. How's that? Forget the mortgages, okay? We actually have a mortgage broker here with me. And he's impressed me definitely more than once. He's come to the rescue. He's saved a few deals for me last minute, and miracle worker, seriously. So if you're out and about and you're gonna go get a mortgage, it can really be in a stressful situation. The steps that they put you through, oh no, you're approved, you're not approved, bring this, bring that. My guest here, I've had people just went from one lender, that told them you're approved, and then they called them and they said, oh, sorry, we made a mistake, and you're not approved. And this is one of my very good customers that was buying a home, and we had already sold her home under contract thinking she's all approved. So guess who I called? I had her call this guest here, Freddy Kling from Simplicity Mortgage, and thank you for being here, taking your time. I know how busy you are, and welcome to my podcast. And this is Mr. T, by the way, Wizard of House podcast. So welcome, Freddie. What's new? What's going on with Simplicity Mortgage? Tell us a little bit about yourself, the kids, and you're from the area, right?
Yeah,
you live here.
Thank you for the opportunity.
You're welcome.
Yeah, so I've been in the area since 1981, and we went to, we could say North Ridgewood. That was my elementary school. That's how long, and that was across from St. Paul's Catholic Church. It was bussed all the way out there, and so that one gives an idea how long I've been in this town. There was a school right across from St. Paul's, but so I've been here since 1981. I have a lot of family in this town. We're well rooted, a lot of entrepreneurs, and went to Embry-Riddle Aeronautical University. Yes. I got a degree in computer science, major in math, and a minor in information technology, and I did that for roughly about 13 years. And I love math, I love software, I love computers,
nice.
And then and at the end of 2016, wanted to make a change in career, and it was an opportunity for me to get a package to leave the software industry. I was working for Symantec, Norton Antivirus.
Oh yeah.
I was in their disaster recovery division.
I wish I knew you then. I had a lot of disasters.
Yeah. Well, that's what I do. I save disasters now in the mortgage industry.
Yeah.
And so, when people are buying houses. But I think a lot of that, where liking numbers really has helped in the mortgage business. It's because in the end, your mortgage is about numbers. It's about your debt to income ratio. And the numbers are determining whether you qualify or not, whether it's the numerical values of your debt to income ratio, your debt divided by your income. So the numbers, and also the guidelines, the rules. When you're in a software, everything's like a conditional statement. You go down the lines in software, if this, then that, if this, then that. And that's just like reading the rules for mortgages. They're all conditional statements, whether somebody qualifies or not. And it's really understanding those rules and reading them, being the subject matter expert. And I enjoy that because I used to read software code for many years, and this is not as dry as software. So learning the rules is really important. And I think with what's coming up this year, starting in May of this year, and lenders will start rolling it out as soon as March, possibly, there's a thing called LLPA, loan level price adjustments. And I think understanding matrices and understanding what it means for somebody to qualify and working with a mortgage broker, somebody that is a subject matter expert in this business, is going to be more coming up.
So is it going to be
ever.
easier or harder for people to qualify with this LLPA, or is it just your knowledge will help them get a better rate because they wouldn't see it? I would say.
I think the LLPA, loan level price adjustments, that's happening behind the scenes. So your average person may or may not know the difference, but to give you some high-level examples would be when you go to buy a home, and if it's a primary residence and you have a high credit score and a big down payment, your interest rate's lower. And if you're going to buy an investment property with a smaller down payment,
it's higher.
lower credit, your interest rate goes up. So those are loan level price adjustments, LLPAs. So depending, your interest rate is determined by the variables of your purchase, the variables of the buyer, or borrower.
Yeah, good credit, bad credit,
So
down payment.
yeah, at the end of last year, there were some adjustments taking place by Fannie Mae. Fannie Mae wanted to make it increase the opportunities for people with lower down payment, lower credit score to get a conventional loan. So they rolled that out at the last year. It was a good change. It definitely improved things. This year, it seems like they made an adjustment to rob Peter to pay Paul, because they've adjusted the LLPAs to where if you're in the middle, your interest rate could be a little bit higher. What does that mean? Well, 740 used to price out from an interest rate perspective is the same as an 830 or an 850.
Exactly. So it was a good credit.
Yeah, that's changed. Now they're adding 3 more brackets above that, like your 740 to 750, 750, 760, up to 780. So now you have to have a 7 greater than a 780 or greater to get
the best rate.
To get the best rate.
And not
so they've added more brackets.
Not have a LLPA apply, yeah.
Well, when you're a 780 or greater, there is a slight adjustment if you have a smaller down payment, but it decreases based on your down payment, less of a hit. So the more down payment you put, the better your interest rate is. To add to that, the 3 brackets, you have all the other variables, like the condos.
So, I mean, that's so technical for a lot of people, but in plain statement, dealing with someone like yourself, you'll be able to see through those with different companies that you work with, right? And you work for the buyer to save them, because depending on what they have, so you know how to go around to keep that as low as possible, those adjustments.
Yes.
Am I right? Kind of? Because it is behind the scene. A buyer, you said, is not going to see that, right?
Yeah, and I think the one other change with LLPAs is there will be a debt-to-income ratio LLPA. So for the longest time, the goal with conventional was just for Fannie Mae, keep it under that 50% for their total debt. So when you do debt-to-income ratio, your minimum monthly payments in your credit report would be in the numerator, like your credit card payments, your car payment, and your new housing payment divided by your income. You had to keep that under 50%.
50%, yeah.
Now, when it comes to income, when you're doing that division, they've added it to where if your debt-to-income ratio is now over 40%, less than 50%, you'll have an LLPA, which will increase your interest rate. So working with a subject matter expert, working with a broker, working with somebody that understands those variables, it's going to put a lot of emphasis on what are the advertised interest rates, and then is there an opportunity to get you a lower interest rate, because calculating income is now more important than ever. So whether you're a nurse or somebody that has variable income, it's you could see where your income could possibly just go over 40, and what you thought and you had in a particular interest rate, an underwriter comes back during the loan process and says, no, your income is less, so your debt to income ratio goes up. Now you're over that 40%, and all of a sudden, out of nowhere, you're going to get a rate adjustment. So in advance, prior to doing a pre-approval, that's what we're very thorough about. The success rate once we pre-approve somebody and getting it closed is extremely high. It could be 99.9%. Yeah, I think the things that get us from time to time would get most people would be if they didn't tell us that they owe back taxes to the IRS. But anyways, I think the big thing, the big thing is going to be the income and getting it right the first time.
Yeah,
and then understanding the matrices that, well, if you have a particular credit score, so if you're in the 720 or 740 range, you could be, if you put a little bit less of a down payment, your interest rate goes down. Or if we calculate the bonus or calculate overtime, you want to make sure that's right to either get it below 40% DTI, or to make sure you could set expectations that they won't be surprised during the loan process after underwriting finalizes their income.
I see. So, yeah, it's very intricate
Yes.
parts of it to avoid a sudden interest rate because you had 41%. So you check all of that. But I mean, how's the market right now? It's, I'm hearing some people are going to ARM, because the rates went so high. There's that 2-1 buy down, and the builders are starting to, a lot of the builders in the country are starting to do this, to offer the buy down for the buyers to buy the rate down. And a lot of times, consumers don't know, buyers don't know. If I'm a first-time home buyer, this is all mumbo jumbo to me, like all the stuff you just said. If a buyer that's bought a home once or just about to buying a first home, right now everybody's scared of these rates because it literally tripled in 6 months. And he just raised the federal fund rate another quarter, right? So he's trying to hit 5% maybe, the Federal Reserve.
And that's interesting that you bring it up. The quarter of a point. That doesn't mean interest rates.
Right,
Your mortgage interest rates go up a quarter point. That's 25 bips, and that's more on the short-term financing. They're not tied at the hip. The Fed fund rate with mortgage interest rates. They don't follow each other one for one. So interest rates, you'll see with mortgage-backed securities.
It takes a while for it to. Well, sometimes if he raises it, I see 6 months later maybe.
I think the thing with interest rates, and when you bring that up, is they trend in the same direction. But a lot of it you could look at as like rumor and news. So the mortgage interest rates they baked in. They were anticipating
exactly
the quarter point. So interest rates already had that quarter point Fed fund rate and adjusted.
Yes, I read that as well.
So and then when the Fed made the announcement on Wednesday, interest rates went down, and quite substantially. So the mortgage interest rates on Wednesday and Thursday went down. Today they're still holding steady, and I think what you mentioned about interest rates jumping. They've come back a lot. They've come back. To get in the fives right now for a conventional and the upper fives right now is not out of the ordinary. And I think that's where you put more emphasis on shopping.
Very nice.
If you are working with like Bank of America, for example, that's where you have your checking and savings. Don't take the easy way out and get a pre-approval through a bank. You should shop 2 or 3 different banks, retail mortgage companies, brokers like me. And, because when you shop for a car, you shop for jewelry, you shop, you're doing all this comparison on what you're paying. Look at what is the long term of that interest rate. What does it make a difference in your monthly payment? So you should shop and understand who can really break it down for you, let you know which loan program is going to be the best for you. Because each borrower that we work with, we make what they call a borrower profile. And everything that we learn about them, it's this homegrown, I could say spreadsheet, for example. And as I learn about the borrower, their variables, their income, their debt, and their employment history, I have a visualization that I share with the borrower in like their email or a document that allows them to see if we make these little bit adjustments, they can qualify, and it puts them in a better position. So that's how we differentiate. But then you're going to see what it means. I do this on a per property basis. So if somebody found a home and they wanted to know if they qualify for it, it's really, they're not qualifying for a max purchase price. They're qualifying for a max monthly payment. That max monthly payment determines the max purchase price. For example, somebody goes around with, hey, I'm pre-approved for $300,000. Well, for what? If you could take that same pre-approval and you go into a home, single family residence, no association, versus a condo that has $600-700 a month or $800 or $1,000 a month in association, well, it doesn't translate to a $300,000 pre-approval. So really breaking it down, when somebody's going to put an offer on a property, this profile that I have, I can take just the new property, plug it into the profile, and they see what their monthly payment's going to be. Taxes, insurance, and hitting on insurance. You can see what it's really impacted people qualifying for a home too.
There's so many factors involved now to get a mortgage. I mean, they're all affecting you have now a little higher interest rate, of course, not a little, but higher interest rates to qualify people with, and then higher insurance prices, and taxes are naturally higher than a year or two ago on all the properties, a little bit. So, like you said, and also the associations, but a lot of times these condos, people have either cash or they put 0.5%, 50% down, but still, people like to know how much is their payment. Like a car, when you go buy a car, the dealer tries to just say, what can you afford a month? What are you comfortable with? And they could sell you 8 years of a mortgage. So it's good to be with somebody that is knowledgeable and can keep you on track.
And to touch on that, a good example we had right here in Port Orange countryside. There was a property that a borrower was really interested. The price came down, and went on the market, went off the market, went back on the market. And the reason you could see some adjustments on that property, the roof was older. It was a frame home, and getting the insurance quote. So when we do a pre-approval and we're unsure about the age of the roof, we see that the home is older, I'll request an insurance quote with an agent that's just phenomenal with doing what that property might be. She'll do an insurance quote on the fly, and then we put that into the borrower profile before they make an offer. So that insurance quote came in at like $3,200 a year. And if you pre-approving them, and we're pre-approving them maybe $1,800 a year or $2,200 a year, that could have possibly
that will backfire.
Well, I mean, but that goes back to the LLPAs, which are more. They're going to influence rates now more than ever because
now he's dead.
The debt to income ratio has come up. They could have been, we set expectations at 39. If they go over 40, now they're at 48 or 49.
So, I mean, how, again, to speak in, layman's terms, just if someone is about to apply for a mortgage, is there anything new that the mortgage companies, lenders are looking at people when they look at people? Anything different as far as the credit scores, their history? What would be something that they should do before they buy a house to get themselves ready? I know sometimes I have people call you that may not be ready, that are thinking, I want to, like I just got a divorce, whatever. I want to know what I qualify. I want to buy a home. I said, well, here, call these 3 lenders. I mean, what is your advice to those?
I think one of the things that we offer is, and it's expensive, but we do it, and we don't put it on the borrower to pay for prior to buying a home, is a soft credit pull. Now, the soft credit pull that we get, they appreciate that because it doesn't ding their credit. And also, when you do a hard credit pull, you have Experian, TransUnion, and Equifax that sell that information. They're called trigger leads. And we also provide some information on how they can opt out of that information to lessen the blow. But the soft credit pull, we get a soft credit pull for all 3 bureaus. And all 3 bureaus really give us, it's the same thing as what you would get from a mortgage credit pull, like the FICO 2 or the FICO 4 or the FICO 5. A lot of people have expectations on what their credit score will be based off of Credit Karma, which is known as Vantage 3 and 4. Or when they get their Discover credit card bill, it says, here's your FICO. Well, if you look at the fine print, you might see FICO 8, you might see FICO 9 or Vantage or Credit Karma. When you see those asterisks down at the bottom, that's not the same thing as a mortgage credit score.
Thank you. Yeah. I've had people go, hey, look, I've got this much. And then they go to somebody like you. They're like, no, that's not the actual FICO that we look at. So that's a great point.
Yeah.
They really should not be going by that. It's not.
I think it's
not the right one.
It's like horseshoes and hand grenades, to be honest with you. It gives you an idea, a proximity of what your score may be, but that's not going to be your mortgage credit score unless you're paying for it and and you read that asterisk, what version of FICO you're getting. So I think the soft pulls allow us, we do all three bureaus and we look at, what the debt is. We plug that into the profile so they can get a visualization of that. But that's going to be, understanding somebody's credit history when they're getting ready. It's not like you go to a bank and they're going to do a hard pull. Or if you go to a retailer or somebody that's going to do a hard pull, we're respectful of your credit because we know how hard.
Guys, what he's saying basically is that, because again, I deal with buyers and they go like to a car dealer or mortgage broker and they're all worried like if I call this guy, he's going to ding my credit again. So when you do a soft pull and then I come to you and then I go to another mortgage broker, he does another soft pull, right? 2 or 3. From what I understand, as long as you're shopping the same industry, you don't get hit.
Yes, a soft pull
does not lower your credit.
Yeah, it's not going to ding your credit for like 2 or 3 points. A soft pull does not ding your credit at all.
At all.
And it doesn't even register as an inquiry. Now,
so if you do a hard pull and I go somewhere else and do a hard pull, it just be once, right?
Yeah, they're within limits. If you're going to do 3 to 5 hard pulls, you would want to do that within approximately 30 days.
Okay.
So if you're going to do your shop and try to get it done within 30 days and 3 to 5 pulls is okay. We haven't seen where, it's dinging your credit multiple times. Now, if you did a hard pull and then 60 to 90 days, did another hard pull, eventually those inquiries build up. And this is a good story. I think, letting, listeners or letting buyers know before they go shopping, be careful when you're car shopping because it happened last year and this year. This is a really good example. So somebody that we were working with pre-approving, we started at the around mid last year, around June or July, and we were pre-approving them for the future. So in November, they went to a local car dealership, and they went to buy a car, and they did a hard inquiry 7 times, for local credit unions or national banks to get, what their credit might be for a loan to buy a car. Well, they didn't buy. So in January, beginning of January, there was some sort of car sale. So we're talking about November. Okay. And then in January,
60 days later,
they went and bought a car. They went to the same dealership. There were incentives. They pulled their credit 7 more times.
Wow.
So in between, and then they came to see me, like we're ready to also buy a home. And now they got the car in there for the ratios to calculate the debt to income ratio. But all of those inquiries hurt their credit score.
Why would it be 7 times?
That's what we see on average. So it just depends on the delership.
Yeah, really?
Yeah. So
same dealer? You mean?
It was the same dealer. Unfortunately,
how could they run it 7 times?
I think this is really important to let people know if you're car shopping, be very careful. My recommendation is to go to a credit union and do your or a local bank, do the shopping, figure out your financing that way. And when you do go to shop a car, you have your financing figured out. Don't let them pull your credit. It could significantly hurt your score if you don't buy or you're hesitant or in the fence and then you buy a little bit later. So be very careful. Even if they tell you they're not going to pull your credit, just be careful because this just happened and it hurt their score quite a bit. When I started working with them, it was around July, and then you had November, and then in January, and now as of last week or the week before, their score took a significant hit.
So they must have come in and go out, and every time somebody ran their credit without them probably not even thinking about that.
Yeah, I don't know about those details. I just know that people need to be careful when they're going to get financing when you're buying a car.
Yeah, and that's really with anything. Sometimes you go buy furniture and they do that. You want to be really careful when you sign whatever application or they put in front of you.
Be careful who you give that Social Security number to.
Exactly. Oh. You can fill it out. Don't put your Social Security number. And if they need it, they'll come back to you. And then you're going to say, why are you doing it? And if they come back again, it's like, hey, I already gave you that. So, that's good to know. Now, tell us a little bit about, okay, I'm a buyer. I want to buy this home. And the rate is at 6.5% or whatever. What can you do to help me qualify? Like, how do I know the buy downs is probably not worth it sometimes from what I hear. So, what is your scenario? I know you told me you're doing this thing for open houses and where the owner can pitch in to buy the rate down for a couple of years. Explain that just quickly, if you would.
Yeah. So the temporary buy down, there are a lot of flavors. To give you a couple of examples would be, it's a temporary interest rate buy down. There's a 3-2-1 and a 2-1. We'll use those two as an example. 3-2-1, think about it for 3 years, and the 2-1 is over 2 years. So the way to temporarily buy down your interest rate near term is to get a seller credit. And we're seeing that now in this market. The buyers have a little bit of a negotiation potential on the purchase, depending, it's almost like a case by case scenario to be, to really.
That's where builders are doing the same. Yeah.
And in this scenario, if you're going to buy an existing home.
Okay.
So, is the seller come down as low as they will in the purchase price? Well, there might not be an opportunity to get a seller credit, but from a buyer perspective, in advance, we work with them in the profile that I was telling you about. Well, would they benefit from putting an offer on a property with a seller credit to go towards closing costs? Maybe they like that. Or if they get a seller credit, they could use it for the temporary buy down. So they could use it for the 3-2-1 or the 2-1. So what's the 3-2-1? So say it is the 6.5%. So the first year it'd be 3.5. Then the second year it'd be 4.5% interest rate. And the third year it'd be 5.5. And then after that it goes to 6.5% interest rate. So the 2-1. So it goes down 2%.
Well, what does that cost? That sounds like a pretty
the 3-2-1, of course, is higher than the 2-1. And it is, that's where it's a case by case scenario. So what it really comes out to is a 2-1, you could look at it as similar as the seller credit to cover your closing costs. So as a buyer, would you rather come down in purchase price when you negotiate? Would you rather negotiate and then reduce your closing costs so you have more money in your pocket when you get into the home to paint, to get a new water heater, to put a new cabinet? Or do you want to use that for a temporary buy down to reduce your interest rate for the short term, 2 or 3 years?
Till
right?
you refi later.
And what that's interesting about like the 3-2-1 or the 2-1. So you get the seller credit and the lender retains that almost like an escrow. And it's a subsidy. The lender on a monthly basis is going to contribute that payment of interest. So say that you have a 3-2-1 or a 2-1, and after 1 year you refi. That money from the seller credit goes towards the balance of the loan, so you don't lose it. It's not like it goes to the seller. You retain that. And for a refi, you have some perks. You had a lower interest rate for a short period of time, and then they go that.
I mean, let's say I'm buying a $400,000 house and I'm putting down $100,000. I'm borrowing $300. What would the seller or the buyer's fee would be that buy down?
Yeah, I don't want to set false expectations
10,000, 5,000.
Yeah, I think the thing here is going to depend on the flavor, right? Are you doing a 3-2-1 or a 2-1? I wouldn't want to hold
2-1.
So 2-1, if I wouldn't want to hold those numbers, but you could expect a couple of % of like what
I'm borrowing or
what you're borrowing. So I don't want to get I don't want to get unless I have something to reference. I don't want to set false. But it's you could either take that same amount to reduce your closing cost or use that same amount. If it was 2% or 3% of the purchase price, it's pretty close to that for a 2-1. It could be 2% of the purchase price that goes to a 2.5 or 3%.
Advertise could say, hey, we could actually list a home and say seller is providing a 2-1 buy down of your interest rates for 2 years. You will have now. Is there a set? Like if it's a 6.5, I mean, is there a set percentage? 2-1, will it go to 3.5 for real?
So if that's the difference between a 3-2-1, so that and it versus a 2-1. So in a 2-1, if it's 6.5%, the first year it's 2% lower.
Okay.
In the second year it's 1% lower, and then it goes back to the interest rate that you closed on with the lender.
Okay.
So the percent, 3-2-1 is 3%, 2%, 1%, and then it goes back to whatever you locked as an interest rate.
And it obviously costs more. When you do
3-2-1, yes, it is quite a bit more.
Yeah, it's quite a bit more.
2-1 is the most popular one.
But you are allowed to refi or pay off the loan or what have you.
Yeah, there are no prepayment penalties. There are no penalties.
But it directly affects your payment. I mean, immediately.
Mm-hmm. Immediately, yes.
So
Day
it's
one.
like a little escrow, a little saving on the side that the bank holds and takes from that every month.
It could easily be hundreds of dollars per month.
Per month.
Savings.
Wow. So that's a good tool if someone is thinking of buying a home and the rates are keeping them from qualifying.
No, you still have to qualify it with the lock.
Okay, so even if I get the seller to lower my rate for 2 years, because you don't know. You don't know after 2 years what happens, so they still have to qualify at the.
They still have to qualify at the rate that they're locked.
Okay, it's not a permanent.
Correct.
Yeah, the permanent solution is to just buy it down.
Well,
buy
that's
the rate down, right?
That's where we would break it down in the profile. We would break down if they.
Okay.
So I provide a whole rate table of their interest rates, and they get what they call an ROI. So the difference between a rate that has no cost, no credit, if they were to go with a lower interest rate, what is that cost and savings per month? And how long does it take to break even on that savings per month versus what they paid to buy down that interest rate?
What if I have some cash and I'm not qualifying because the rate you're giving me, but if I can put some money down and buy it down, I get qualified.
Yeah, that's possible.
Right?
Yes, that's a possible scenario.
Yeah, so it happens. I mean, sometimes people are so close, but they have the money to put down. So it all depends on everybody. At the end of the day, gets down to the money, man.
Yeah, and that's where it comes to a case-by-case scenario. Understanding the borrower, what is it? Do they benefit more from seller credit towards closing cost, the temporary buy down, the permanent interest rate buy down, or just bring in the total purchase price down? So when they negotiate, when they're going into making an offer, we have that figured out.
So when you look at someone's credit, I mean, how bad is it if you're seeing a couple of lates, a car repossession 5 years ago? I mean, what does this mean I'm out? There's no way and I'm at like 600 credit score.
Well, appreciate you bringing that up, because that's a part, that's the diversity in our portfolio, why we have 20 lenders in our portfolio. They're more out there than that, but we look for the best. We get the best of the best. We maintain relationships with all of our lenders. It could be a credit union. It could be a wholesaler that has no retail presence at all, like UWM, for example. UWM is probably one of the largest, mortgage company in the nation right now. They do more mortgages than Rocket. They do more mortgages than Wells, Chase, Bank of America.
Wow.
So they do the most mortgages. They turned number one at the end of last year.
Is that United?
United Wholesale Mortgage. UWM.
Mortgage.
They do not have retail, so they work with people.
And they've
like
been
me.
around a long time.
Oh, good question.
I personally haven't. I don't think I have heard of UWM
until working with me.
But it's now the biggest.
Yeah, they're the biggest
mortgage company
in the nation.
So they're doing wholesale and mortgage to public.
Yeah, they're just mortgages. That's all they focus on. They offer HELOCs. Everything that you can get from conventional. Your Fannie Freddie. They do FHA, VA, USDA, and they do HELOCs. But that's one lender in our portfolio. So the other 19, we have 20 total, allows us to have a lot of creativity. So we can go down to a 500 credit score. We do have lenders when they have derogatory events on their credit report to get them into a home. It's really understanding all the variables in their credit history to figure out which lender is going to give them the best program.
Do you have any good stories to tell us about some of the loans you've done?
Well, what about the one that we had with you?
I have a few stories.
Yeah, but the one. Well, I'm saying the one that was a really good story would be the one that they were self-employed and they sold their business, so the income had stopped, but they had a lot in reserves, right? They had a lot in reserves. So we have a loan program that doesn't care about income. So you do not have to provide employment history, no W-2s, no tax returns, no pay stubs, none of that. The loan program, if you have 20% to put down,
Is that called a statement loan or no?
No, it's not a
That's
statement.
not-
No, we have that.
statement
We have
loan,
that
you
also.
have to get the
Yeah.
bank statements, right?
So this one
Or what
really,
you state, I make this much.
yeah, no, they don't even look at your income.
Yeah.
They don't. There's no debt to income ratio.
Know that, yeah.
Yeah, so they look at your credit history and they look to see, like, and if you have a bankruptcy or a foreclosure, the seasoning period to qualify is really short. But it really looks for the people that have the money in the bank. They have at least a couple of years in credit history. You have 20% down and you have 12 monthly payments and reserves. You qualify. You don't have to have a job. We have other no-income loans like
And credit?
credit. Yes, it can go down to a 640.
Yeah.
Yeah.
Oh, okay.
Okay. An FHA, VA, for example, we can go down to a 500. Once you get under a 580, the criteria gets a little bit.
But your rate
it's a
is
little
high. Like, right?
Well, I
Wouldn't
mean,
it
that's
normal?
it depends on the market. So yes, it is higher. Anytime your credit score is lower, your rate goes up, but it's still achievable. There's the opportunity if that it may be when you get under 580 that you just have to put 10% down for FHA, for example, to go all the way down to a 500. You have to show that you're improving on your credit history. So if there are some recent events, it could be problematic, and then we have to look at a different type of loan program. But if in the past couple of years, if you have a 530, 540, or a 560 credit score, there is an opportunity for you to get an FHA loan.
So you have a program really for everybody.
We're
Pretty much.
quite diversified. Well, the one we closed last week, so it didn't even need a credit report, no credit report, no income, and no appraisal. That one that we closed last week was all they cared about was collateral. They didn't care about the bank statements, anything. All they cared about is the buyer, the amount of down payment, which was 20%, and the property that they were buying. So the lender looked at the property, determined based on what it is worth as collateral and how much he would need as a down payment.
That's it.
No credit, no income, no bank statements.
Wow. And what kind of loan is that? What is it called? Like investment?
Private.
Private. Private, 10% or more?
It was 20% on that.
20%?
Yeah. So
That's the rate?
No, not the interest rate. That it was 20%. Well, we have lenders in our portfolio that will do private, that will go, get creative financing with us, and the interest rate varies significantly. So they just depend. It's a case by case scenario, but I would say that it is possible to go with a private lender and to get in the upper sixes with us. So that is totally possible. But yeah, to go even higher, that could be a scenario depending on what you are buying.
Everything you say is nice, but just tell me, why should when I go to my bank versus I go to a mortgage broker, is the closing costs different? I mean, do you charge more? Is the origination, the point? Some places charge you, again, a lot of people don't know what a point is. Mm-hmm. They don't know what the origination charge is. The 1%, the 2%. Mm-hmm. I mean, why should I come to you instead of going to the bank if I have an 800 score?
Yeah, so
I know you can shop the rate for me.
Yeah, and I think it comes down to shopping and understanding.
I mean, closing costs,
Yeah, we're not more expensive.
Okay.
We're not.
Good.
And I think the scenario when you have to get creative or go private, yes, it could be more expensive.
Yeah.
But when you fit in with conventional FHA, VA, USDA, we're extremely competitive. And I think, that's where I recommend shopping around 2 to 3 different lenders. When you come to us, when we break that down, you're going to see the savings. And mortgage brokers were recognized at the end of last year for who was saving the borrower the most money. And it was mortgage brokers. It was substantial per loan. Mm-hmm. So I can't put enough emphasis that, take the extra time, get your loan docs, and don't hesitate to go to whether it's me or multiple banks or mortgage brokers to see.
I remember my doctor friend that I sent to you, mm-hmm. and he had gone to a big bank here, and mm-hmm. the bank did his application, ran everything, and then they started giving him a lot of hard time. He was calling me. He goes, "I've had it," and I said, "Listen, just call Freddy," and he called you. And he called me back. He's like, "Oh my God, I can do 10%. I don't need to put 20 in."
Yeah, and I think that's
he was so relieved. And of course, we closed on his home, and he's happier ever after.
You won't see all the junk fees with us. It's just, we don't have excessive fees. What you might see typically working with the lenders, we don't underwrite the loans. So there might be an industry average, what you might see like in an underwriting fee that could be like $900 to $1,000. There's nothing really excessive.
You having the ability to shop versus the bank doesn't, right? With the bank, they have only like maybe 3-4 programs, and that's it.
You
can go to 20 different lenders, companies, depending on what is on my portfolio, and you can shop for me and find a guy. And then once you tell me, and this is what I like about Freddy, when he says you're pre-approved, when he calls me and he says this customer is now pre-approved, give me 2 days, and he digs and you give me that pre-approval letter, and I know that's good.
Yes.
It's not just a lot of people come to buy a house and they send in I'm pre-approved. And as a listing agent who's getting an offer, I I read the letter. It's telling me, based on what you told us over the phone and, a quick check with it, a soft pull or whatever, you're approved. But, there's so much out there that they didn't check.
Yeah.
They haven't checked my income statement, my W-2s, my tax returns, my real credit check, all my debt. They haven't seen my credit cards. So you do all of that, and that's what I like about you. Is you when you tell me, okay, you're approved, but we're gonna keep an eye on this and this and this. And sometimes you just make me nervous just to get on me. just to make me nervous.
Yeah, I think just to add, one of the statements you made there, taking a couple of days, not necessarily. It really comes down to how fast your buyer gets us the loan documentation. So, for example, when it comes down to self-employment, being able to, whether it's Schedule C, S Corp, or whether it's pay stub, whether it's variable. So, if they have those docs ready, typically what holds up a quick pre-approval would be the borrower providing those docs to finalize the numbers to issue a pre-approval. But yes, very thorough. One of the really cool things that we have is we can do a soft credit pull and submit it with their loan application and their soft credit pull and run what they call an automated underwriting service for conventional Fannie Mae, Freddie Mac, and FHA, VA. So right now it's working for conventional. Government loans are coming out shortly, but we can run off a soft pull to really get the thumbs up from Fannie and Freddie based on the application and the credit report. So it can be done with a soft pull. So it's not really, my analysis and the borrower profile allows me to feel comfortable with what we're doing. We'll take it and submit it and confirm where their algorithms go through the application and the credit report to give an automated go. And it's nice to get that confirmation because it's just as good as a soft pull and a hard pull.
And what is this? Some companies have a forensic check now, or credit check or something. They really know everything about you, because one of them actually was wrong. They accused one of my buyers that, oh no, she's on that other house. I'm like, she's not. And I had to go get the deed and send it to them. And then they're like, oh, our forensic report was wrong. Sorry.
Yeah, they have additional tools to go out there and look, and because we had a scenario that somebody inherited land and didn't know it, and when they inherited somebody passed away, they inherited land and they owed back taxes on that land. So and they caught that, they weren't even aware, so they were able to go and make it current. So the forensics out there do catch things time to time. It's very rare. When you go with a government loan, there's also like FHA, VA, USDA, but especially with FHA, there's a report that, it has to be submitted to the lender to run the report. It's called CAVERS. So a CAVERS report, it returns if they have derogatory federal debt or they owe the government something. So there's another report in addition to that's really important that could, forensics. Yeah, I guess it's just an additional tool to do a background check to make sure that they've told the lender what they own and the story is complete.
So again, my guest, Freddy Kling from Simplicity Mortgage, has all the solutions. It sounds like you can pretty much approve anybody.
Almost.
Almost.
You still have to have a down payment.
Yeah, he can even
Or
make his magic, get the rate down, whatever.
Yeah.
So don't give up, guys. I know the rates have scared off a lot of people. It's just a matter of getting used to it, like the gas prices, right? We had $5 and people still have to fill up their tanks.
Yeah.
And before you know it, when he went down to 4, we're like, yeah, but that's high.
Yeah.
So it's just a matter of time. But, he has a FHA. You have the USDA loans. You still do that, right? Certain parts were to 100% financing. U.S. Department of Agriculture, they give loans on certain areas. Like, for example, if this is I-95, they say, okay, everything west of 95, we do USDA loan. And there is, do you do VA loans?
Yes.
Yeah, VA loans, home equity line of credits, HELOCs.
Conventional.
He does conventional, FHA.
Bank statement loans, it could be personal or business.
Yeah,
so
he has all kinds of magic.
To touch on a couple of programs that we also have, there's an investor loan that's based off cash flow. So if they were to put it doesn't care about their debt to income ratio. It doesn't care about their income. It cares about, it's called DSCR, debt service coverage ratio. It's an investor loan that it uses variables as of when the appraiser goes out there, the appraiser determines the value of the property. The appraiser also determines what is the rent potential of that property. So when you're getting this loan program, you're going to have a monthly payment, including the taxes, insurance, and principal and interest. And association fees. And if the appraiser goes out there and says this property can generate $3,000, $4,000, or $5,000 a month, and your mortgage is $2,000 a month, anything that's greater than one, when you do the division, the rent divided by the mortgage, say it's $2,000, one or greater, you're going to get a decent interest rate. Now, something to add about that's where when we do a lot of condotels, and it's rent divided by mortgage.
So how do they reach you, and what is your website? Do you have a website?
Yes, they can go to
go ahead.
They can go to simmortgage.com, short for simplicity, SIM, mortgage.com. For loan application, I'm also known as Finance Freddy, so they can go to financefreddy.com, and will take them right to the loan application.
Financefreddy.com. Okay.
And then we have a website that, since we're so competitive, they can get our interest rate at simrates.com, simrates.com. That's where we advertise our interest rates also.
Oh, okay. So I can always just type in simrates.com, and I'll see the most current rates.
Typically updated daily.
That's it, folks. Thank you so much for listening to my podcast, Wizard of House podcast by Mr. T. I'm always here for you if you have any questions or if you need to reach Kevin. Freddy.
Oop.
Kevin is his brother. Freddy, what was your phone number again?
386-401-9000.
386-401-9000. Freddy Kling. And this is Mr. T. Make sure you check my website, mrtsells.com. That's MRTSELLS.com. And again, you can always reach me on my cell phone by text, which is the most preferred method nowadays. 386-299-8989. Mr. T at mrtsells.com. Thank you so much.